Good morning to everyone that has joined us today, and welcome to the latest in our webinar series on the Goods and Services Tax. As some of you may be aware, India's recently introduced GST is likely to be implemented from the 1st of April 2017, and this regime is expected to change the landscape of doing business in India. The GST, which is a single tax on goods and services across India, will apply to manufacturers and consumers alike and has been marked as a starting point for a single market across India, improving economic and efficiency and productivity. Today, we will specifically be looking at the implications of the GST to UK businesses in the energy sector, covering exporters and investors already in the market and those who are looking at India as a potential market. Before we begin, I'd like to familiarise you with the toolbox on the right-hand side of your screens. Just so that you are aware, everyone will be kept on mute during the course of the webinar, but if you do have a question, please type it into the chat function in your toolbox. We will then raise these questions during the Q&A session. I'm now pleased to welcome our speaker for today's session, who is Mr. Samsudha Majumdar, who is a partner at Trilegal. Samsudha is part of the tax practice group at Trilegal and has more than 12 years of experience in both direct and indirect taxes. He has advised clients on a wide range of tax matters, including customs duty, central and state excise, VAT, and service tax, to just name a few. Samsudha specializes on complex supply chain and operational structuring of manufacturing and infrastructural operations from a direct and indirect tax perspective. He has provided structuring and hand-holding assistance to several major internationals in the setup of manufacturing operations relating to aerospace and defense, heavy engineering, automobiles, and white goods. He has extensive experience in providing tax advice and structuring assistance in relation to all kinds of infrastructure and utilities projects. And without further ado, I'd like to hand over to you now, Samsudha, to take us through your presentation.
Thanks for the introduction, Rebecca. And hello, everybody. Good morning to you in the UK. It's afternoon here. Today's session, as Rebecca said, is on the impact of GST on UK entities who have some kind of interest in the energy sector in India, whether it's exporting into India or whether it's in investments into Indian companies who are engaged in the energy sphere. So I would like to keep this presentation, start from the very basic, because I do not know whether everybody who is listening in has a basic background of GST and what level of background everybody has. So to start off with, it's important to understand that GST is not really a simple tax reform where one tax gets replaced with another tax. It is probably the most far-reaching and all-encompassing tax reform that has been attempted in India since it became an independent country. In the last 70 years, we haven't had any kind of tax reform which is as far-reaching as this, because it basically replaces what are a huge number of local, state, and union levies with one single tax structure, and therefore there's a huge capacity to simplify and rationalize the way in which businesses are done in India. So it's not only a tax reform, it's an overhaul of the way entities are likely to do business in India going forward, because of the simple reason that because of the inefficient indirect tax structure that used to exist in India, and we will probably spend a few minutes discussing that. A lot of supply and distribution models were actually designed to optimize or find a way around the very high indirect tax costs caused due to this multiplicity of taxes. Now GST sort of changes that by introducing a system which is very similar to the EU VAT or the VAT systems that are there in Canada, and Australia, and New Zealand. And because of the federal structure in India, it's a dual GST, but it's a single tax in the sense that the way you comply with the tax is under a very similar legislations on both center and the state. So it's a huge simplification of the way in which entities could possibly do business in India. Next slide, please. Next slide, please. If you look, slide 6, please. Sorry. No, so, next one, please. Yeah, so then currently, I mean, the Indian energy sector could be conveniently broken down into the conventional sources of energy, which are basically thermal power, hydropower, and nuclear power, and UK entities generally have a strong presence in both thermal power and coming up because of the civil nuclear agreement between the India and UK. There has been interest in the nuclear sector as well. The non-conventional sources of energy that are prevalent in India, which are wind energy, solar, as well as agriculture and domestic waste recycling energies. There are UK companies which are engaged in all of these areas, and I mean, we can go into more detail as we speak in this slide. Next slide, please. Next. So just a brief overview of the existing indirect tax framework. If you look at this chart that's there in front of you, these are the taxes which are currently applicable on power projects in India. And as you can see, there are a huge number of different types of taxes, all of which comes with their own compliances and issues with respect to classification, valuation, and other day-to-day issues that you will have between the tax officer and the company. So an import into India is subject to what we call a customs duty, but the customs duty itself is basically comprises of two main parts. One is an entry barrier, which is the basic customs duty, and the other part of it, which actually is a combination of several duties, is called the countervailing portion of the customs duty, which comprises of countervailing duties to offset the effect of domestic taxes. So there is a countervailing duty for setting off the effect of excise levied on Indian manufacturers. There is a special additional duty to set off the effect of VAT, and so on. So you basically pay one part of customs duty as a entry barrier and the next part of customs duty as a countervailing tax for local taxes. Interstate procurement, so a procurement into a power plant from another state, for example, would be subject to an interstate sales tax called CST, Central Sales Tax. It will be subject to an entry tax in many states, which is a tax on entry of goods into a state. Similarly, purchases from within the state will be subject to both an excise and a VAT. A VAT currently is basically a local state level tax on sale and purchase of goods. Separately, there is a separate tax on services which a power plant might procure, and that's subject to a service tax of 15%. Now, all of these go into creation of electricity, and electricity itself is subject to a separate duty, which is the electricity duty. And therefore, there is no cross credits, and there is a huge amount of cascading effect of taxation. Having said that, please go to the next slide. Previous slide, please. Previous slide, please. Having said that, one thing to note is that currently the energy sector, especially the renewable energy sector, enjoys a lot of exemptions and concessions, and you might see that some of them are mentioned in the chart, due to which this cascading effect of indirect taxes is cushioned somewhat, because the government realizes that all these taxes adding up, and then thereafter there being a electricity duty on the generation of power itself, would create a very high and prohibitive cost for electricity in India, which is why a lot of mega power projects which are of a certain size and meet certain criteria, have exemptions from customs and excise duty. A lot of states give VAT exemptions to the power projects, and this is especially so in case of renewable projects. Renewable projects generally are exempted from customs duty and excise duty on imports and domestic procurements. They're exempted from VAT and CST on purchase of goods. However, service tax tends to remain a cost, and there is no generation tax on renewable energy as well. So renewable energy tends to get a lot of tax benefits in the present regime. Going forward, we'll have to see how that works out in the case of GST. Next slide, please. So the model GST law, and this is where we look at what will change once GST comes into the picture. The model GST law, which is what we have now, we don't have the final draft legislation. We have a model law which has been provided by the government for our feedback. It basically comprises of a dual GST structure, and there would be basically a GST which is levied by the state government and a GST which is levied by the central government. And as long as the supply is within the single state, both these taxes will be imposed separately. There would be a central GST called CGST and a state GST which is called SGST. And the cumulative rate would be the sum of the two, which is going to be, if it's, for example, if it's 18%, it's going to be 9% to the center and 9% to the state. If it's 28%, it's going to be 14% to the center and 14% to the state. However, when a supply is interstate, which means that the supply crosses the state boundaries, then it would be subject to something called an integrated GST, IGST, which is basically the sum of the two, which means that if it's an 18% rate, you pay 18% GST instead of a separate SGST and CGST, and this is only because of administrative convenience. The reasoning is that GST is a destination-based tax, and the tax is basically meant for the state in which the consumption happens. So the integrated GST is paid in the state of origin, but the central government takes half of that and gives it to the state in which the consumption happens, which is why you pay one tax, but at the government's side, it's again split into two and it goes into the destination state's coffers. An interesting thing to note is that while GST is supposed to be an all-inclusive tax, it's not perfectly all-inclusive. There are fault lines already that you can see in GST, and these are basically because of political reasons. And one of the most significant things that are outside GST even now is electricity. So the production and generation of electricity or the supply of electricity will be subject to the earlier laws, which are basically electricity duties of several states, and will not be subject to GST, which obviously causes a lot of issues with respect to cascading effect of taxes, because electricity is not only dependent on goods which are subject to GST for its production, but it itself becomes an input for every other industry going forward. Another important sector which has been kept outside GST. Next slide, please. Next slide, please. Yeah. So another important factor which has been kept outside sector which has been kept outside GST are certain fuels, and this is also very relevant, especially for the conventional energy sector, for the simple reason that previous slide. For the simple reason that fuels play. Some of these fuels are some of the common fuels used for generation of electricity. Now, before we get into that, we'd like to talk for a couple of minutes on the possible rates of GST. Now, we don't have a schedule of rates, so we don't exactly know what would be the rates of specific items. But there is the 5 rate bands which have been announced by the government, and what you see in this chart is basically a basic idea of what kind of goods might find their way in these rate bands. So there would be a zero-rated band which will comprise few items only, but those will be essential commodities, things which are required for sustenance and life itself, and usually low-value product or original farm-based products. There would be a merit rate of 5% for things such as edible oil, spices, tea, coffee, etc. There would be another merit rate of 12%, which would be a wider collection of goods actually, because it would include IT goods, it may include industrial inputs, it might include industrial capital goods, it might include processed foods and other merit items. And a lot of the industrial inputs that go into production would also find its way into these merit goods. 18% is the revenue neutral rate, as we call it. It would be the rate of goods for all items which are not in any specific schedule. And 28% is kind of a luxury / sin rated goods, which would apply to luxury items such as high value watches, high-value cars, or goods which are considered not very or considered harmful for human consumption, such as alcohol or tobacco. Next slide, please. So right now we don't have clarity on where would the fuels which are inside GST find the place, where would industrial inputs find the place which are specifically required for the energy sector, but very likely they are going to be either 12% or the residual rate of 18%. Coming to how the credit mechanism of GST works, you have basically the center and state maintains their own credit schemes. That's basically the takeaway. You adjust, and at every stage of production, you get a credit which you can take off, which you can use to offset against GST payable on the output side, which is very similar for anyone who is familiar with VAT in UK or the Europe. It's very similar to that. However, electricity, as I mentioned earlier, is not subject to GST. So that's where the cross-credit mechanism fails, because any kind of input that goes into the energy sector becomes the GST on those inputs become a cost, because you pay electricity duty on the output side, you pay GST on the input side. Next slide, please. Coming specifically, and that was a description of how GST would work in general. Now coming to more specific case of energy projects, if you, next slide please. In case of energy projects, now it's the same chart that you saw in the beginning, where you saw those indirect taxes. You notice that it becomes a lot simpler, but at the same time it's not perfect, because what you have is you have GST and interstate purchases on interstate purchases as well as on input services. You have GST, and on imports you have basically the basic duty, which I said was the entry barrier, and all the countervailing taxes get replaced by IGST, which is the interstate GST. So it's basically a GST in the input side with a possible basic customs duty on imports, and on the output side you have your power generation, which is subject to electricity duty and generation tax. The reason we have put a question mark on generation tax is because generation tax is not applicable in all cases of generation of electricity. It's not applicable, for example, on renewable energy. It is only applicable in case of conventional source of energy, and there are other exemptions available on that as well. So this is how it remains, and the reason I say that it's simplified but not perfect is because while the multiplicity of tax compliance and tax rates that you have to deal with go away, what doesn't go away, the fact that the taxes on the input side cannot be set off against the taxes on the output side. Next slide, please. Next slide, please. Next slide, please. Can you go to the next slide, please?
Hello, Samsudha. There might be a delay in the slide changing, so if you are able to continue with the presentation, it should change at your side soon.
So I should go ahead without with the slide being the same?
Yes, please.
Okay.
Thank you.
No problem. Yeah, so in specific issues with respect to the energy sector, like I was mentioning some of them, electricity is outside the ambit of GST. Electricity duty and cross subsidy surcharge will, these are the taxes on the supply of electricity. They continue to be applicable. Previous slide, if you might. Yeah. GST cannot be set off against taxes on electricity, and therefore GST on inputs, capital goods and services would be costs to the company. It continues to be costs. And next slide, please. Another important issue is that fuels, for example, are 5 key fuels are outside the ambit of GST. These are crude oil, natural gas, aviation fuel, diesel, and petrol. Out of the and fuels which are within the ambit of GST are kerosene, naphtha, LPG, coal, and various other fuels. Now, obviously, when we look at conventional source of energy, coal still is, at least in India, the major conventional source of thermal fuel. So, but of late, natural gas has been one of the key fuels used for the generation of electricity, at least in India, and diesel is at least on a smaller captive use. Diesel generation sets are very popular in Indian industry, and therefore these are the 2 fuels which are outside the ambit of GST, and therefore there's further cascading because the taxes, input taxes that go into generation of these fuels will become a cost even at the stage of these fuels being generated, and then these fuels will be subject to an excise duty, which would again be a cost for the generation of electricity. So there's a double cascading in case of conventional fuels such as natural gas and diesel. Next slide, please. Now, coming to the specific case of the renewable energy sector, we'll see that one of the biggest implications of GST are the fact that there are reduced concessions and increased costs. And how is that the case? We can go over that very quickly. One is that GST, one of the key objectives of GST was to remove complications and unnecessary number of exemptions and special cases from the Indian tax landscape. So one of the mandates of the government was to create a tax structure which is simple, has very few rates, has very few exemptions, and has very few exceptions. So everything is treated very similarly. And because of that, a lot of major exemptions which the energy sector used to enjoy, which basically made the impact of the cascading effect a little less than what it would otherwise have been. The status of those exemptions is kind of uncertain right now because the government hasn't really told us whether any of these exemptions would be grandfathered or they would be carried forward under GST in some other way or they would be gone altogether. So there are exemptions under VAT, under various state laws, there are CST concessions, there are exemptions under customs and excise, mainly for mega power thermal and hydro projects, as well as for various kinds of renewable projects. So the implications for those kind of exemptions is not very clear, which basically may lead to higher, and if these exemptions are not grandfathered or carried forward in some way, these may lead to higher cost of EPC contract. But at the same time, they may reduce the amount of litigation on account of classification and valuation disputes, which is very common in the Indian landscape today. Similarly, because there is no difference of rates between GST within for consumption within a state and consumption interstate, there would also be no structuring possibilities because a lot of current indirect tax structures are based on the fact that there was a rate arbitrage between the rate of inputs and capital goods bought within the state and bought from another state, and often buying it from another state would be cheaper because the central sales tax, which is the interstate tax, sales tax, was cheaper than VAT in most cases. But that arbitrage was no longer available. Next slide, please. So I would like to, now a lot of these points on status of exemptions and concessions I've already talked about, and the next point is again I think we can go to the next slide, please. Another point is regarding the cascading effect of taxation. GST is supposed to reduce the cascading effect of taxation, and to a large extent it is true. But for the electricity sector, this may not be true in every respect because of the fact that electricity is outside GST. it creates that cascading effect, and because electricity itself is an input for other sectors of the industry, that cascading effect is likely to continue. However, currently the treatment of the sector is kind of in a flux. Government has been receiving concerns from the industry on this regard. They might explore options to reduce the impact of this cascading effect on the energy sector. Maybe there might be proposals to zero rate supplies to the energy sector so that refund is available to the energy companies. But all is not doom and gloom, because GST does have certain benefits to the energy sector as well, and these are in the next slide. Reduction of legacy issues. A lot of the current energy sector landscape in India is plagued by the huge amount of litigation, especially with respect to indirect taxation, because of the rate arbitrage that is there between not only supplies within the state and supplies from outside the state, but also between the rates of service tax and VAT. A works contract currently in India is taxed in a very unique way. Part of it is treated as a sale because there is an element of goods being supplied, and part of it is being treated as a service because there is an element of labor that goes into it as well. And what is the exact bifurcation between the part which is subject to VAT as goods and part which is subject to service tax as services is a constant source of dispute between the authorities and the taxpayer, because there is a difference of rate between VAT and service tax. That kind of controversy is likely to fall away because of the fact that under GST, the entirety of a works contract is treated as a service and will be subject to a uniform GST. Similarly, to take advantage of certain, and these are, I'm getting slightly technical here, there was something called in-transit sale exemptions, where in the course of a interstate movement of goods, if the title passes hand for more than one person, so there's a subcontractor and a contractor and a final project authority, then the tax is levied only once, but only if the goods do not actually physically change hands, but only change hands by way of transfer of title when the goods are in transit. Now, a lot of contracts are structured in such a way as to take advantage of this exemption. Now, that kind of structuring also led to a lot of litigation, and these litigations also, I mean, the takeaway here is that these kind of litigations which are predicated on current indirect tax laws will fall away, and therefore the tax implementation landscape is likely to become much more simple. Next slide, please. The last point is how GST would be treated as, how the impact of GST would be felt in the current power purchase agreements that companies have, whether it's UK energy companies or anyone else, has with the government authority, with the power regulator. Normally under the power purchase agreements, you would look for a change in law clause to deal with situations where there is a change in law which impacts the price at which electricity is supplied to the grid. However, in our review, a huge proportion of the power purchase agreements did not have a change in law clause, or the change in law clause was not broad enough to include something like a GST coming in, which is very strange considering GST has been in the pipeline for almost a decade now. And once signed, the PPAs are normally non-negotiable documents, and therefore, in those documents it becomes very difficult for the power company to pass on the increased cost of power to the consumer because the tariffs are fixed. And this could lead to problems that, to the extent that, and because the tariffs are competitively bid for, this could lead to a lot of issues which may even render the tariff price inefficient and economically unviable in the context of GST. There have been a lot of concerns that have been raised on this in regard to the Electricity Commission, and they are obviously looking at this. So hopefully there will be, in the PPAs where there is a change in law clause, the risk is somewhat lower. But in the PPAs where there is not an adequate change in law provision to cover for GST, the Commission may allow these PPAs to be renegotiated at least to that extent. Similarly, EPC contracts also need to be looked at. I mean, when you are negotiating with your EPC contractor for the EPC portion of the project, then it's very important to carefully look at the change in law clause, because the EPC contractor sometimes works on a tax-inclusive manner, and sometimes the taxes will be passed on without limitation to the owner. So it's very important to look at EPC contract laws. It's very important to look at the financing of your projects, where the cost might escalate significantly once GST comes into picture, at least in the short term. Next slide, please. So just as a way forward, there are certain recommendations we would like to make to anyone who's in the energy sphere in India, whether they're exporting into India, or they're manufacturing in India. One is look at renegotiation of EPC contracts to account for, if you're in the EPC space, to look at renegotiation of EPC contracts to account for increase in project costs due to change in law. The change in law clauses have to be looked at very carefully. Future PPAs, power purchase agreements, have to take into account cost incidence. So if you're entering in PPA right now, be very careful about what kind of change in law clauses are there, and have it reviewed very specifically from the perspective of GST. There is a very important need for strong industry pressure from the energy sector to continue existing or continue grandfather existing exemptions available to power projects, especially for renewable power projects, which are otherwise not the most efficient in terms of cost to electricity output ratio, and therefore would not be viable without these exemptions today. And going forward, I mean, the ideal situation would be to bring electricity under the ambit of GST, and also to bring those fuels which have been kept outside the ambit of GST into the ambit of GST. But that might take a little bit of time because these changes are for only political reasons, really. I mean, these exclusions, they don't make any sense from a theoretical perspective. So the building a political consensus may take some time. I think that's all for me. I apologize if I sort of sped through the presentation a bit. I was not sure whether I'll be able to finish in time, but I'm happy to take any questions or go over any issue one more time if necessary.
Thank you so much, Samsudha, for that presentation and for covering both the general and the more detailed aspects for the GST impact on energy companies. I did want to ask you what the biggest change will be in the regime for renewable and non-renewable energy companies.
So for renewable sector, the biggest change that you would see is that there would be a price hike on account of the fact that the renewable sector, especially in the mega power and hydel side, have certain kind of exemptions which would most likely fall away. But at the same time, the renewable sector, the impact will be lower as things stand today in comparison to the non-renewable sector, because the non-renewable sector currently has absolutely, you could say, 0 to 3% total indirect tax in terms of its total input costs, because almost everything is exempt for the non-renewable sector, and which is very important to develop that sector, because obviously it's lagging behind currently in terms of how much of the share of electricity it produces. But unless these changes unless these exemptions are grandfathered, I think the impact felt by the non-renewable sector would be much higher than the renewable sector. The renewable sector would survive, but non-renewable sector, I think the impact would be very high unless some of these changes, these exemptions and concessions are somehow carried forward into the new regime.
Thank you, that's very interesting. And could you also let us know how GST will impact the niche UK energy technology companies who are looking at co-developing or transferring technology to India? And also, could you elaborate on what kind of entry strategy would be most suitable for them, and whether it be joint venture or wholly owned subsidiary?
Also, for import of technology into India, for right now, there is a regime which is basically a mix of service tax and something called an R&D cess. That would be replaced by GST. There would be a GST on import of technology, which would be basically payable by the Indian joint venture or the Indian company to whom the technology is being transferred. Now, typically the cost of service tax is 15%. The cost of GST on services such as this is likely to be 18%. So there would be a 3% increase in that cost. But other than that, I don't see too much difference in terms of the cost of importing technology into India. Both of these become sunk costs. The service tax today and the GST going forward, because the electricity, the local joint venture or subsidiary which is producing the electricity out of the technology and selling in the Indian market is not able to get credit of that. But the difference in the increase in tax costs is going to be that 3%, so it's not going to be a huge difference. As regards the question as to whether it would be the entry structure would favor subsidiaries or joint ventures, I think to a large extent GST would be agnostic to whether it's a joint venture or it's a wholly owned subsidiary, because that decision is more predicated by direct tax considerations rather than indirect tax considerations, because for the way GST would apply would be sort of agnostic to the nature of the Indian firm to whom the technology is being transferred and who is the sort of local presence of the UK entity in India.
Sure, that's brilliant. Thank you very much. We haven't had any more questions come through, but if we do receive any via email, which our audience submits, we will pass these on to you. And I'd just like to thank you very much for speaking on our webinar today. It was really interesting and, of course, very relevant for a lot of the companies that are within our membership. So a big thank you to you. And to our audience, I'd like to also thank you for taking the time to listen in today, and hope that this webinar was valuable. If you have any feedback or comments about today's session, or you have a session that you'd want to see us do in the future, then please do get in touch with us. Thank you very much and have a lovely day.
Thank you. Thank you.